Hello, welcome to another episode of the Bitcoin Standard Podcast. In today's seminar, our guest is PlanB. PlanB is a pseudonymous Dutch investment manager and analyst who has taken the Bitcoin world by storm over the past couple of years since he came out with a paper in early 2019 that attempts to model Bitcoin's price based on the stock-to-flow ratio. And those of you who read the Bitcoin Standard will remember my book, The Bitcoin Standard, discusses the stock-to-flow ratio. And PlanB read that book, and he decided, like a good quant, to model it and to see if we can find a quantitative relationship between the price and the stock-to-flow ratio. And it is something that I was extremely skeptical of at the beginning as somebody who considers himself an Austrian economist. I did not think that you could establish regular and predictable economic relationships between numerical metrics and real-world phenomena like the price, which is the product of human action. And yet that price has held up pretty well, I would say. Since March 2019 until today, the predicted price of Bitcoin, or the actual real world price of Bitcoin, has not been more than 2 standard deviations away from the price predicted by the model. And this includes the last 2.5 years, or almost 3 years now, 2 years and 8 months since the model came out. That includes quite a lot of things that have happened. We had the coronavirus crisis. We had the global economy basically shut down. We had Bitcoin crash significantly after that. We also had a period in which Bitcoin recovered enormously. We had Michael Saylor come in and buy billions of dollars worth of Bitcoin and put them on their balance sheet and begin evangelizing to the world how they should buy more and more Bitcoin. We also had Elon Musk, one of the world's largest companies, put Bitcoin on their balance sheet. We've had El Salvador, as a country, adopt Bitcoin as legal tender. We've also had China ban Bitcoin, which China was the biggest center for Bitcoin mining. We've had, and probably the biggest place for holders of Bitcoin, perhaps as well. And yet they banned Bitcoin. And through all of that, we've never seen the price, and we also had a halving as well. And we've seen the price go as low as $3,000 and as high as $69,000 yesterday. And yet through all of that, the price has not been anywhere, not for one day was the price more than 2 standard deviations away from the predicted price. So here to discuss this sorcery today is PlanB himself. So thank you for joining us.
Thank you very much, Saifedean. And I feel like a sorcerer sometimes, a magician. But yeah, like you said, it's pure math. In the end, it's kind of amazing to me as well. So looking forward to our discussion.
Yeah, so I think perhaps I wanted to just start with all of these things that have happened. All of these, in March 2019, if you told anybody that we're going to be witnessing these kind of things taking place, they would have expected that any kind of prediction done before that, before these things take place, if you told somebody, well, China's going to ban all mining, then they'll tell you, well, yeah, any price prediction is going to have to break at that point. And yet we haven't. So I'm going to begin by asking you, what do you think of that? Like, did you expect these things to happen? And did you expect the model to continue to hold through all of these things?
Yeah, I did not expect that those things to happen. The Chinese miners, maybe, or some other government being mean to Bitcoin and banning it or something, but certainly not COVID and the whole period that came after that, and certainly not all the other big spikes and liquidations that we have seen as well. So all those specific things. I could not foresee. Nobody could foresee them, and certainly not model them. But that's the nice thing about a model, that you cannot model it all. It's a simplification of the reality, and you focus on one or two or a couple of variables that roughly describe the path, allowing for volatility and these black swan events or outliers, if you will, in the model. And so basically, I think what happened is that, regardless of the Chinese mining ban and COVID and the whole period after it, et cetera, regardless of that, the overarching fundamental force driving Bitcoin price is the scarcity, and the fact that more and more investors recognize that scarcity and compare the scarcity and the asset Bitcoin with other scarce assets like gold, real estate, and diamonds. And I think that in the end is the main driving force. That's of course also the hypothesis in my.
Yeah. Well, I think you've said before that your criteria, or one of the criteria that you would accept for the model being correct or accurate, is whether the predicted price, whether the actual price crosses the predicted price once a year, right?
Yes.
Do you still stand by that? Do you think this is like a be-all, end-all for the model, or is it just one nice to have?
No, I think it's important. It hits on the subject of co-integration, because correlation measures the fact that when the scarcity goes up, Bitcoin price goes up, and it goes simultaneously up and down. So the variance of the one scarcity has a relation with the variance of the other. But co-integration means that the real price sticks to the predicted price really close, and doesn't wander off too far, and that the difference between those two, the model price and the real price, is on average a constant. So yeah, that should happen. Otherwise, the model is will fail. So if we stay for next year, for example, or for next year, next 2 years at the current level, or even below that, the model is invalidated. It is very obvious also from this chart that in that case the model would not fit the price. And the same is true for if it goes up. If it goes to a 1 million and stays there, that would be overshooting the model. And so no, I think it's really important. And the problem with the co-integration tests is currently that we need two random variables to be allowed to apply those co-integration tests. And the price for sure is a random variable, but the stock-to-flow ratio is sort of determined. Not really. I mean, we cannot predict when the next halving is exactly, and there is variability because the blocks do not arrive every 10 minutes. But roughly, you could say when what the stock to flow will be a year from now, 2 years from now, even 10 years from now, and that's what makes it the stock to flow model such a great predictor, because you know the input variable with a certainty. But the disadvantage is you cannot apply the co-integration tests. If you do the co-integration tests, by the way, you will find co-integration, but we cannot apply the test. So that's a bit of a bummer. But what the test measures is how much the price sticks to that model. And I translated that or dumped that down as, it's above and below the black line, the model line, each and every year. So yeah, I think that's very, very important.
Yeah, I think it's a good way of specifying it. The metaphor that somebody used is that it's like the drunk person walking home with a dog. How do you know if they're actually walking home together? The further away the dog goes from the drunk person, the more likely it is to come back. But if it goes further away and then it drifts even further away, then they're likely not walking together. So here we see, like, if you look at since this model came out, and this is really the interesting thing that a lot of the detractors don't really seem to care about, which is even if you were not convinced about this model retrospectively, the out of sample predictions since early March 2019, it's now been almost 3 years, it has been incredibly accurate. I mean, if you look at it, in March 2019, it was $3,000 or $4,000 when this came out. And at that point, I mean, what the model was saying was, no, the price today should be closer to $8,000 or $9,000. And that sounds insane because, you're putting out the model saying, hey, I'm predicting Bitcoin's price. The price today is 4,000, but actually the price should be 8,000. So you're starting off making a very bold claim. You're out there saying, yep, the price today is wrong. And my model says 8,000, which is, a great way to, get laughed at. Because, here I'm making a prediction and I'm starting off by saying that, Bitcoin's price is wrong in the real world. It should go up. And yet, this is the kind of fascinating thing about it is reality obliges. Reality just went ahead and said, yep, he's right. And we went from 4,000 to 8,000 in a couple of months after your model came out. And so, initially people would have laughed and said, yeah, the model is too high. And then within a few months, people were laughing and saying, yeah, the model is too bearish. The model is saying 8,000, but the price now is about 13,000. And, this is just a very bearish model. And then what happens is the price goes back down to 8,000. And then it starts coiling around the predicted price until the end of that period before the halving. And, we're getting to the period of the halving when the halving was going to happen in May 2020. And we see here, we're arriving at the halving and the price is very close to where the predicted price is. So that's when, some people started to grudgingly accept that maybe this thing has some validity to it. And then COVID happens. And COVID happens and the price goes from 8, 9, 10,000 or so all the way down to about 4,000. I think it was the bottom, or was it 3,000 and the bottom in March 2020. The entire capital market of the entire planet were falling apart. Bonds and stocks and everything and commodities was collapsing. The price of oil was negative. Everything was shut down. All of the world's models of everything collapsed. And it looked like this model was dead in the water as well. If we're going to get a new global recession because of this pandemic that's going to move it's going to bring the price down, we'd have the price, maybe spend the next few years around 3,000 or 2,000. Looks like it's kind of invalidated. And yet, immediately, it bounces back and it goes right back to the predicted value of 8,000. But that's when right in time for the halving, when the predicted value begins to rise, because the model is built around the halving. And then we get a few months in which the Bitcoin price doesn't rise, as would have been expected. And so we start getting some haters gloating around here, around August 2020, when the price was, the model was predicting 15, 20,000, but the price was still around 8, 9, 10. And then that's the time when we go back up, and again, it goes back to the predicted value and then overshoots it. And it starts going almost to the edge of the first standard deviation area into the kind of second standard deviation. And that's when we start getting the haters saying, well, this has been invalidated now because we're going to get the super cycle. We're going to go to the moon and the model is too bearish. And that's, that continues up until May 2021, when, the predicted price was somewhere in the range of the 30s. But the real price was in the 50s and even 60s. And then China ban comes along and the price crashes again. And now the model is invalidated, but because the model is too bullish. So you've managed to, I think this is the irony that the haters don't get, which is that every year they claim the model is invalidated on the upside and the downside a couple of times. Which is just shows how extremely precise it has been. Even with all of the movements in the Bitcoin price, ultimately This line, what the model predicts was, in May 2020, the price is going to keep rising up until around the middle of 2021 or late 2021. The price has followed this. We've gone over the previous all-time high as predicted, and we've stuck in this range, which is absolutely amazing. And I think the really most amazing part of it is what for many people was, this was the invalidation of the model, that the price went out of the one standard deviation range after the China ban. But for me, the fact that you have China, which bans Bitcoin, where the majority of Bitcoin is being mined. Perhaps the majority of Bitcoin miners, Bitcoin holders might have been in China, because, a lot of the Bitcoin exchanges started off in China. If you look in 2013, 2014, the majority of Bitcoin trading was taking place on Chinese exchanges. So most likely we've had a lot of Chinese whales. It's not entirely inconceivable that China had maybe not the majority, but the plurality of Bitcoins owned by Chinese people. Maybe not so much in 2021, but maybe like 2018, up until 2018, maybe this was the case. And yet, even though that gets criminalized and people in China have to get rid of their coins or sell them abroad or get rid of their miners, still, the worst that we got was that the price slipped out of the one standard deviation era, and now it's back into the same range. It's absolutely amazing.
It's like a horror movie or an action movie, right? It's especially if you describe it like that, in a sequential way. But it's, the entire reason that we have a model is to protect against our own emotions, right? Because I know very well how I felt during that entire 3-year period, and in a way that that in the depth of the COVID crisis or the China crisis, you feel bearish, very, very bearish, and you're tempted to sell everything, and I think the world falls apart. But that's when the model saves you, right? And the same thing is true when the model when the price is up and everybody is FOMOing. It's especially in the top when Elon Musk tweeted that Bitcoin tweet and everybody was FOMOing. I was like, oh, we were at the high part of the standard deviation band. So don't get too excited. So even then, your greed and fear is sort of tamed by mathematics, and I like that so much. I need it, because you cannot invest without the mathematical guidance, and you will be ruined by your own emotions. And by the way, I know some hedge funds, it's more than one or two, that use this exact model to do this trade. So to buy when it's at the outer bands, at the lower bands, and to sell when it's at the upper bands. So you could, if you do it well, it's very risky though, but you could make money trading this thing as well.
Yeah, it's very true. And I think I've thought very, very long and hard about what this means. And I think it's inescapable in my mind that it is telling us something very profound about how Bitcoin works, which is that, the ratio of the new production to the existing stockpile has to be significant in the price formation. And this is unique to Bitcoin. I don't think you could do models with this kind of precision to any other kind of financial asset, because all other financial assets don't have this constant, which is the value of or the number of new Bitcoins produced. It's a constant number. We know there's only 21 million Bitcoin, and we know the schedule at which they're produced. This kind of constant gives us it defines the stock to flow, it defines the scarcity, and it gives us an idea about how the price is going to perform, because it's giving us an objective metric. That's the key thing. It doesn't matter what the price is. The value of the new production and the ratio of it to the existing production is always going to be objectively measured by these metrics, because as the price goes up, the value of the existing stockpile goes up, but also the value of the new production goes up. And so this relationship is kind of immune to changes in price. That's why I'm not so sure about people who talk about a super cycle. I don't think we can get a super cycle for this reason, for the fact that at this level, we just have something like 2% of the value of Bitcoin is going to be produced every year, and that's just a lot of Bitcoin. It's a lot of new Bitcoin, which requires a lot of new holders. And so, yeah, when we get the halving, we reduce the number of new Bitcoin. That creates a lot of interest, and it creates a lot of new money coming into to Bitcoin. But there's a limit on how much money can come in, because the more money comes in, the more that the new production increases in value, the more inflationary Bitcoin becomes. That's the thing. The way that I think of it is we can't have, what this model is saying is that we won't have $1 million Bitcoin in 2021. And if we do, it's likely going to be, for a very brief period, and then we're going to come crashing back down. Because $1 million Bitcoin today means we have about $1 billion of new Bitcoin being produced every day. We have 900 Bitcoins being produced every day. So at $1 million, that means we've got $20 trillion of Bitcoin in circulating supply. And the existing supply is 20 million, or let's say 19 million right now. So 19 million times 1 million, that's 19 trillion. So we need $19 trillion of hodling. But on top of that, we need a new $1 billion of new hodlers every day. And that's a lot. That's one Michael Saylor every 3 days. And that's just, that's a lot. And, Bitcoin is still new. And I can't see us increasing to this kind of level this quickly. With this kind of new production, I think, with 900 new coins, this is kind of the natural range of where we can be. We can be at around 100,000. I think it's sustainable. Yeah, at 100,000 and 900 new coins, that's about $90 million a day. Yeah, I think we'll go up above that. We'll go below that. But it's not reasonable to expect us to go significantly above that, because that's new money that needs to come in every day to buy Bitcoin.
Yeah, I agree with that. And I agree. It's probably a fundamental. It's more fundamental than we might think at the moment it is, because it looks like a fitted line, the Stocktoflow model. But I think the scarcity argument is a fundamental argument as well, because that's also how I started out making that model, right? Because there's other scarce assets like gold and silver and diamonds and real estate, and it would really, really surprise me if real estate, which is a much higher stock-to-flow value than gold and Bitcoin, for example, if the value would be lower, and likewise if Bitcoin surpasses gold in stock-to-flow in scarcity, it would really surprise me if the market would not put a larger price ticket on it. And so there's some very fundamental scarcity force at work here. That's what I think. And we haven't figured it out completely yet, because it's now in its rudimentary state, if you will, like put out in 2019. But yeah, I'm very, very curious what people, or maybe myself, what we will find in the future, if the relation can be tightened or even defined better. And then I also agree with the fact that, for example, the human nature will not change. So greed and fear will drive this market as well. So there's this scarcity force. There's all sorts of black swan events like COVID in China. But there's also greed and fear. So people will be greedy, and when they go 2x or 3x, some will sell, but others will think it will go 10x or 100x, and they will stay and buy, and then
leverage.
Yeah, exactly.
This is the key.
And the same when we go down, then people will be. There's people bearish. Oh, it's all over. This was the top. We crashed to 64, or where are we at the moment? But look at what you're saying. We crashed to 64. That's a crazy price, right? 64,000. So we'll be saying we crashed to we'll crash to 100,000 a couple of months from now, and then that'll be fine. But the greed and fear, I'm sure, will be there. People don't change that easily.
Yeah. No, I agree. You know, we've had you here before in one of our seminars. It was almost a year ago. It was in December 2020, and you said during that seminar, you said, this model is young. The next year will be a test of whether it holds up. So I presume, this test so far throughout this year has held up, in your opinion, right?
Yeah, absolutely. I think the China ban was kind of that set it back a little bit, put it off track, and even out of the one standard deviation band, which is rare, as you can see in the history. Although it was outside of that one standard deviation band when I made the model in the beginning of 2019. But yeah, on average, it's very well on track, beyond my highest expectations, and I think. Yeah, crossing the 100,000 level this year, or I shouldn't say that, but or early next year, but I guess it will be this year. That will be the real. Then I'll be like, okay, this is it.
Yeah.
And
yeah, I mean, so by your criteria, you're saying it has to cross the line. It's already crossed the line into 2021. We've already gone across the line. So 2021 is already in the bag. So basically, by your metric, which you defined early on, I think you may have said this in 2019, Bitcoin needs to cross the $100,000 line in 2022. In order for this model to continue to be accurate. I have another metric for success. This kind of probably similar. I think both mine and yours will be met together or broken together. Mine is, I'd like to see, for me to think that the model has broken, I'd like to see the price spend 6 months outside of the 2 standard deviation band. I think if it spends 6 months outside the 2 standard deviation band, then we can say that it's not very useful. It's been broken. And I think, people underestimate, a lot of the people who hate on this model don't quite understand what a standard deviation band is saying. So the one standard deviation, what this is saying is that, this dark blue panel in this chart, and we're looking at the chart from the Twitter account S2F Multiple, which is set up by Bitstein, our friend at and this account, the one standard deviation, dark blue band, what one standard deviation means is that you would expect 67% of observations, 67% of price points to fall within that dark blue band. And you would expect 95% of observations to fall within the light blue band, or the 2 standard deviation. So by that metric, we are far outperforming this metric. We've basically had something like 95% of observations since the model was released have come in the 1 standard deviation band, and 0% have come outside the 2 standard deviations. So we're already, you look at this, you see 95% of the days it's within the 1 standard deviation. For it to break, it has to spend more than 33% of the days outside the dark blue, or more than 5% of its days outside of the light blue. But we are running at maybe, I don't know, for the 1 standard deviation, maybe it's about 5%. And for the 2 standard deviations, it's like 0% of days outside of this band. So it's still a very far way from breaking. And looking at where it is, the fact of the matter is, right now, for it to break, it needs to spend several months being over $400,000, or several months being under $30,000. And that just doesn't seem very likely to me, given everything we know about Bitcoin and about the things that are happening. I think even the most bullish bulls will tell you, yeah, it's going to take a while until we get to 400,000. And, it's going to be a while. And then by 2024, that's when we get the next halving. And that's when the model predicts that we're going to start rising to the next digit that we had, which is the 1 million. So it's not easy to see this break, right?
Yeah. And people will say those are wide margins, right? 30,000 to 400,000. That's a 10x margin, and that's true, right? It's a very wide margin. It's a very rough model in that way, but I think it's still very, very useful because there's lots of people thinking that Bitcoin will crash or will spend a lot of time below 30,000, and at least we can say, well, that's not going to happen.
Yeah. No, and I kind of disagree with the idea that it is a very wide range, because it's a very wide range when we're stuck in the middle of it because the model is so accurate. But really, if you look at this chart, I mean, Bitcoin has spent the last 10 years going from under $1 to $68,000, and it could potentially go many, many multiples more than that. So it's an extremely narrow range in the range of possibilities that are available, which is 0.0001 to $100 million of Bitcoin. This is actually a pretty precise range, and it's telling us, it's not under 30,000. So last year it was telling us it's not going to be over 30,000. It's not going to be over 20,000. During the previous epoch, the previous halving period, it was telling us that the price doesn't go over 20,000. And indeed, the price never went over 20,000. Now it's telling us the price doesn't go under 30. And indeed, we see it's not going under 30. That's an extremely valuable piece of information. And as you said, when you're dealing with something so violent, so volatile, the emotions are shifting all the time. And if you can have this as a kind of compass of where we probably should be, you've probably done much better than if you had let your emotions take control.
Yes, absolutely, and you're completely right. I mean, some people say that's a wide range, but if you look at the y-axis, you see 8 orders of magnitude, and that's enormous. If a model is right over 8 orders of magnitude or 7, that's crazy. And I have investors, big investors, not traditional investors, right? Institutional investors that came to Bitcoin and that came to Bitcoin and stayed there because of this chart. Maybe not so much the model, but just the price chart, seeing this exponential growth over 6 or 7 orders of magnitude in 10 years. So over that long period, that tells you something is going on. There is a sort of constant growth, adoption, or whatever there, and investors, traditional investors like me, have never ever seen that in their entire lives. I mean, the closest thing is maybe Tesla or Google and Facebook, and that's a bit of a wrong example as well, because those big tech stocks were very volatile in the beginning, so just after the IPO, and then the volatility decreased and they just went up and up and up because of adoption. And with Bitcoin, it's slightly different because the volatility doesn't really go away. It's still a 80 to 100% implied volatility asset. Those implied volatilities, you can measure those from the option prices. That's what the option market calculates for the 100% volatility is crazy. So there really is some underlying trend going on, and an institutional investor can watch for hours at this chart and shake his head and say, well, this isn't possible. This cannot be, and yet it's there.
Yeah.
And with that high volatility as well. So the volatility sort of blurs everything on smaller time scales, but if you look at this chart over 10 years, it's just the most amazing thing you've ever seen as an investor. And you're hooked.
I agree.
Or you don't understand, or you're hooked.
Exactly. And I think I think this is massively underrated. So you've got an enormous amount of attention. You've got now, 1.3 million followers on Twitter?
Yeah.
Which I think is a testament to just how much signal there is in your account. And I think it's you're like on a different level from other Bitcoin or even crypto accounts. I have 150 or something. People in the Bitcoin space are in the few 100,000. People who have 1 million are usually in like if they're into Bitcoin, they're also into other kind of things. And I think your model has attracted a lot of attention from mainstream finance. And I think I still think it's massively underrated, because the majority of people in traditional finance don't care about Bitcoin and have a very strong bias against Bitcoin. And so they're unlikely to look at this with an honest perspective and try and figure out what's going on. They just think, oh, tulips, who cares? And then people in Bitcoin, a lot of them are just very fascinated with Bitcoin and not so much into quantitative analysis and investing and modeling. And I think also, perhaps the Austrian sympathies of many of us might preclude us from looking at numbers. But I think with time, this is just going to become harder and harder to dismiss. One interesting kind of attention you've gotten is Fidelity, one of the world's biggest asset managers. They've turned into a PlanB fan account recently.
They did, yeah. It was a great compliment to see them use my model and giving the credits as well. It's because it's very. I know I did business with Fidelity in my earlier life as an institutional investor. Fidelity and BlackRock are the biggest asset firms out there with trillion-dollar balance sheets. So, yeah, seeing them use the model and giving the credit, it's a big thing and big milestone. And I know the effect that goes from that, because others will see that as well. And it's extra hard for them to mention my name, for example, because you need a credible source, right? You rather point towards a journal of finance or some Nobel Prize winner than to an anonymous Twitter account. That's not done in that world. And for example, also CNN or CNBC or Wall Street Journal will have difficulties with that. But still, they all, even CNBC and Wall Street Journal mentioned this crazy PlanB nickname, and it was kind of funny to see that as an anonymous account you can grow that hard. It's crazy to me.
Yeah, and it's also, you're not very active on Twitter. It's not like you're out there posting every day and trying to get engagement. Some of the bigger accounts, that's what they do. They're constantly posting the same. For instance, Google is down, Bitcoin is never down, RT and all of that. And you're not fishing for engagement. You're just out there and putting out real signal. And it's landing. It's definitely landing.
Thank you. Yeah. And on the other hand, if I look at the exponential growth rate in my followers, then that is constant as well. So it's about 20% per month. So 3 years ago, when I made the model, it was I had 1,000 followers, and then a year later it was 10 times that. It was 10,000, and a year later was 100,000, and a year later was 1 million. So it's really, really constant. So I can't think about next year, but
10 million next year.
That would be crazy. And to be honest, it's becoming a daytime job as well, right? With all 80% are fans, but 20% hate my gut. So that's 200,000 people that hate my gut and with all kinds of scam and spam and impersonators and troll comments on there. So I mostly just disregard that. But it's an entire new world that you get sucked in. And 1 million is really a lot bigger than 100,000, because
I've had a much more gradual growth, and I've spent a lot of time, actively culling my people who interact with me, just blocking people at the earliest sign of being an idiot or saying something that is a waste of my time. And it's allowed me to kind of make the experience a little bit more manageable, because, you might get to troll me on Twitter, but you will only ever get to do it once. If I see something stupid in my mentions, you're getting blocked, and that's it. But with your case, because of the growth being so fast, it's impossible to do so. So I wish you the best of luck. But it's a nice problem to have.
Well, noise control is very important. I did that in the beginning as well, to keep the signal and keep the noise out, just the idiots and the trolls. And but now I cannot block anymore because it's too much.
Yeah.
It would be a day job for 3 people to just block all the idiots. I can't do it anymore. Even the impersonators that are under every comment and every new follower. Those are bots, right? So every new follower is contacted directly on its first day with an impersonator that is trying to scam in my name. So that's very, yeah. Uh, I don't know. I think it comes with the size, but I don't like it.
Yeah. So I wanted to switch to the other model that you recently mentioned. This was pretty outlandish. This was at the bottom of the at kind of the bottom of this current bear market, mini bear market in the bull market. When in June, the price had been crashing since May. The price started crashing in like May after the China ban. And in June, you said that your expectations are for the model that your worst case scenario for 2021 is that we're going to finish August. We're going to finish July over 28K, August over 47K, September over 43K, October over 63K, and then November over 98K. So what is that sorcery now?
Yeah, first of all, it's a different model, and there's a lot of magazines that got that wrong, right? It's they're saying, hey, if it doesn't hit the 98 or the 63, then stock to flow is invalidated, and so much people love to see the stock to flow model invalidated, but alas, it's not the stock to flow model. It's indeed an entirely different model. It's a technical analysis based model, but with slightly different math. It's you can compare it with a 200-week moving average model that serves as a trivial floor model for most investors, because you can see that the 200-week moving average never goes down, always goes up, and the monthly close of Bitcoin has never gone under the 200-week moving average. So that's a 4-year moving average. So that would be a very trivial floor indicator, but it's very wide. The price can be very much above that 200-week moving average. So,
okay, so it's not that you. But I mean, how do you come up with that? Because we don't know what the 200-week moving average is going to be at the end of December from June. There's still another 6 months,
right.
which is another 25 weeks, and well, that's about.
It was just an example, because my floor model is not the 200 weeks moving average. I just know that a lot of people use that as a floor model, and indeed you cannot predict with that model. You can just say, okay, we're now very close to that 200 week moving average, so that this must be the bottom, for example. But my model is slightly different, because the 200 week moving average and frankly most technical analysis is taken from normal markets, equity markets, foreign exchange markets, and Bitcoin has this very specific nature, this exponential nature that we talked about, that it goes over 6-7 orders of magnitude in 10 years time, and with a lot of volatility as well. It's not normally distributed at all. So forget about averages, forget about standard deviations. You need something else. You need a little bit more exotic math. And Nicholas Taleb wrote a lot about this kind of math. It could be power laws and fractal dimensions, Hurst components. That's the area that I took some measures from, and that allowed me to predict not far in the future like stock to flow, but at least a couple of months out in the future. And let me say this also, right? It's a floor model. It shouldn't be under those measures, those numbers. So 98 for November and 134,000 for December. Unless there is a black swan, of course. I mean, it is a mathematical thing. It is a model, and it has been spot on for the last 3 months. But I could be wrong, because there could be a black swan event. There could be a thing, but at least if it well, to make it very concrete, if we don't hit the 98,000 in end of November, that would be a first on this specific indicator in the entire history of Bitcoin. So in the entire 11-year or 12-year period. So that's why I can be so confident about it. And of course, it's in line with Stocktoflow prediction, right? So the 135,000 end of this year would be crossing that white line in the chart you show right now, and it would be exactly in line with the Stocktoflow model, and so that gives me even more confidence that in both the floor model and the Stocktoflow model that there's both two clocks telling the exact same time.
Yeah. So the way that you see it, we're still due for, there's going to be a mania top similar to 2017 and 2013, right? This isn't going to go as smooth sailing from now on, right?
Indeed, yeah. So I think the greed and fear in people will stay, and that's causing the FOMO tops and the crash bottoms, and that's amplified, of course, by leverage. People that lend money to invest in this already very volatile and high return asset, which is very stupid. You should never ever do that. That's you're certain ticket to hell. You will get liquidated. So, but it's fun, of course, to to play in. But yeah, so that and that's basically it. So I think indeed that it will not be a super cycle just yet, but it will have a FOMO top, and that can be even higher than we might expect, right? Because if we look at this chart, the FOMO top in 2017, the 20,000 was about 3 times above the 7,000, 7,500 model line. So if we would project that on today's Stocktoflow value of 100,000, you would get a top of 300,000. But then if you look at 2013, it was like 10x above the model line. So that would imply a $1 million top in, say, 2022, which is unthinkable right now. But well, we did it in 2013 and actually in 2011 as well. So it wouldn't be it wouldn't be impossible, but I certainly think that after that the fear kicks in, something happens, some people take profit or are going to hedge themselves with futures, and the whole thing starts tumbling down, and we crash back to I don't know to where, but yeah.
So you think we still got big crashes left in us, right?
Yes, and in a way that it must be like that, right? It's we get this high returns because there is high volatility. You cannot have one straight line up, because everybody would be buying Bitcoin and nobody would be selling. And I've never seen an asset that does have only upside and no volatility. It's in fact it's a capital asset pricing model, a famous Nobel Prize winning model that's sort of the centerpiece of all finance, with a lot of critics, of course. But and that says there is a very distinct relation between the risk and return. So you cannot have the return without the risk.
If we had that, we'd have shot to 100 million already, and it would be over. Exactly. If there was no risk and volatility involved. But it has to be there because, this is a process of discovery, and knowledge is not, and this is one of the big problems that many of the critics have, is they say, well, if people know this is going to be the case, then people would just bid the price up and the model would be invalidated. So the model is self-invalidating. But it's not true, because knowledge is not, there's no such thing as the market knows. The market is made up of billions of people all over the world. Every single one of them has their ideas about what they know and what they think, and many of them are wrong. Many of them believe in ridiculous things like the efficient market hypothesis, and many of them don't know about Bitcoin, and many of them don't think that Bitcoin can be modeled like this. So they're still going to go through the emotional roller coaster of greed and fear, and they're still going to be over leveraged. This is the key thing. I think, as the price goes up, people become over leveraged, and as the price goes up, the new production increases. So it's kind of self-correcting in a way that we can't just have that super cycle, because you get, as the price goes up, people will over leverage, and the new product and Bitcoin will become more inflationary. The new production, the value of the new production is going to increase. So because the new production is increasing, Bitcoin becomes more inflationary. We need an increasing number of people to come in and buy more and more Bitcoin. But all the hardcore Bitcoiners are already overstretched because they're already over leveraged. And eventually we get to a point where the new money can't keep up with the new production. And that's when you start getting a little tick down. And then some people start getting liquidated. And then they can't come in and buy more because they got liquidated, and so now they have to sell to cover their liquidations, and then you begin the liquidation casket, and everything begins to fall apart faster and faster and faster, and then we get the crash. This is this dynamic. I discussed it with Michael Saylor. I had maybe the most popular episode that I've had on this podcast was with Michael Saylor when he came on, and we spoke for about 2.5 hours. It was a very, very fantastic discussion. But in that discussion, we disagreed about one thing, which is, he said, I don't think we're going to be seeing many more. I don't think we're going to be seeing big crashes in Bitcoin. And I made the case for why I think, yep, 70, 80% crashes are still possible. And he said, no, 30, 40. Well, since then, we've had a 56% crash, which is kind of in the middle between the range that I gave and the range that he gave. But I think I still stand by my opinion that I think we'll still see 70, 80%. And, that doesn't make me a bear, because we could end up with a 70, 80% crash that takes us down to 80,000. And that,
it's actually
depends
very
on how high we go.
It's very interesting because Michael, I know why Michael thinks that, because he of course has a lot of experience in investing in high-tech companies, Google and Amazon. That's where he earned a lot of money with investing in those companies. And in those companies, the volatility was in the beginning, when the adoption was not clear. But once the adoption kicked in, it was one straight line up. And he thinks the same is true for Bitcoin. But I would agree more with you, I guess, that the volatility stays, and that Bitcoin is not a company like Google and Amazon, but more like a commodity or a currency, and money in the end. By the way, I do think that we will have a super cycle or hyper Bitcoinization event eventually, when after the next halving we surpass the stock-to-flow ratio of real estate, stock-to-flow ratio of 100, then it will become the most scarce asset in the world, and probably also the most valuable asset with the highest market value, above 100 trillion US dollars, hence my name. So yeah, and that's where the stock-to-flow model sort of ends, right? That's where we have no data anymore. Then we're in terra incognita. We don't know what a stock-to-flow asset of 200 will be worth, and probably that means that asset will be the de facto money. And right now if we look at that chart on the y-axis, we denominate Bitcoin in dollars, but that will probably not make sense anymore at that time. And probably indeed the dollar might be replaced by something else, Bitcoin or the special drawing rights of the IMF or something else. And of course, all the gold investors hope that will be a gold-backed thing, gold-backed world currency. But I think there's a real chance that Bitcoin will be that better money, thermodynamically perfect money. And then of course stock flow model is done or must be changed, in that the dollar is not we cannot measure it in dollars anymore, and Bitcoin should shift to the denominator of all other assets. And so really, really interesting times ahead.
Yeah, I think the ship of gold has likely sailed, and I think I have two comments on what you said. First, on gold. First, the ship has likely sailed, and I think that's because the stock flow for gold right now is arguably much lower than what official data suggests, because official data considers all gold to be part of the stockpile. But I think a more accurate definition is you need to differentiate between the gold that is used in industry and the gold that is used as a store of value. The gold that's used as a store of value is the liquid stockpile. That's the stock. That's the thing that is in the market. But the gold that's used in industry is tied up in machines. Effectively, it's like it's been buried underground and now you need to mine it again. Yeah. So there is gold in your laptop, but can you use that to pay off your debt? Not in the laptop, right? You need to break the laptop open and you need to take it out, and there's a cost to that. And it's just like mining gold all over again. And I think this is, when I think about how silver got demonetized and how copper got demonetized, it's when the industrial use increases. That means that the stockpile declines, because a lot of the stockpile is going into industrial use. So it's getting buried effectively under the ground of these industrial uses. And therefore, the new production, the flow, becomes a more significant part of the stockpile. So the stock to flow ratio declines. I think this is definitely the case in silver. If you look at silver, some people will tell you that the stock to flow ratio for silver is around 30. But for that, they're calculating all of this silver stockpile that is used in all kinds of industrial uses. And even in jewelry, I think in the case of silver, silver that's used in jewelry is not really used as a store of value. It's just it's not an expensive metal. It's just a way of making jewelry. It's no different from plastic. When you buy a necklace that's made out of silver, say the value of the silver in the necklace is maybe $5, but the value of the necklace is $500 or $100. So the silver itself is an increasingly insignificant part of these things in which it is used. So it's not really a monetary use. And I think the same thing is happening with gold. And we've had a debate in a previous episode of this seminar with Mark Valek on whether gold is being demonetized. And this is my opinion. So a lot of the gold bugs will tell you industrial use of gold is always going to make it better than Bitcoin because it'll always have a use. But for me, the industrial use just actually reduces the monetary stockpile and therefore decreases the stock to flow ratio and makes the metal more like an industrial metal and less than a monetary metal. So I think this has been the case with gold for a while now, and it just continues to get worse and worse. And I think, the last 2 years, we've had incredible inflation all over the world. And basically every single thing on the planet has outperformed gold, everything. And I think it's gone, the idea that gold is used as money. It needs to appreciate very, very significantly, very quickly, to the point where all the industrial uses are priced out. And that just doesn't look like it's going to be happening anytime soon. And I think the rise of Bitcoin has delivered the knockout blow, because now all the people that are looking for gold from a kind of real store of value, asset protection, inflation hedge, they're just getting into Bitcoin. So all of that money that could have given it the impetus to increase in value and reduce industrial demand and go back to increasing the stockpile, all of that I think is being driven out of it. But we've discussed this before about when we can think of the model breaking down. And I think, I used to think that, obviously eventually it's going to break down because, eventually we're going to run out of dollars. But I have another idea, which is perhaps actually it doesn't have to break down anytime soon. Maybe it can take several decades, because I think what we're ignoring the fact that we can just continue to make more and more dollars without the dollar breaking down. And I think with all of this talk about central bank digital currencies, it might be the case that with the central bank digital currencies, I think it seems, and we've also had an episode where I discuss this and I talk about what I see as, the great monetary reset. If you look at the way that all the world's governments got together and cooperated on COVID in a very, very, very suspiciously friendly way, it's pretty amazing how they all got together like that. And I think this kind of international friendliness between them might just be the same thing that we're going to be witnessing in the next few years as we begin to witness inflation problems. We might see all of these governments get together and introduce a new central bank digital currency, that is a central bank reserve digital currency. I think this is probably the plan, where instead of having the US dollar as the global reserve currency, we have a new, sort of like the IMF SDR, which is going to be used as the reserve for all central banks. So then, the US and China and all the world's central banks will have that currency as their reserve asset. And that currency will effectively be made up of the dollar and the yuan, most likely, and possibly the euro. So in that regard, if we just take the exchange rate between the dollar and the new currency at the time in which it happens, and then continue to extrapolate the value of the dollar as time goes by, then I think this is the way that I see it is that this is how they're going to be hiding the inflation. As inflation increases over the next couple of years, they're going to, I can already see the scam unfolding. I can already see the foundations of the scam being laid out, which is, the same kind of people who believe all of the bullshit around COVID and all of the bullshit around carbon dioxide and cow farts boiling the oceans. It's not a stretch to make them believe that the reason that the dollar is losing value is because of all of these digital currencies being so much better at holding value, and that the way to fix the dollar and the way to fix inflation is not to stop government spending, because that's crazy. Why would you stop government spending for inflation? It has nothing to do with it. Everybody knows inflation is not caused by inflationary monetary policy. So the way that they're going to fix it is that they're going to introduce a new digital currency, and they're going to tell you, we're going to move away from this old, outdated 20th century central bank currency, and we're going to build a new 21st century central bank digital currency that's digital. It's going to be like Bitcoin. And the idea is, if we ape the shape and form of Bitcoin, we can ape Bitcoin's number go up technology. Obviously, it won't work in the long run, but it'll work enough for them to basically buy themselves another few years or a few decades, maybe even, where, the inflation happens, then they just issue a new denomination. There's going to be a new currency, whatever it's called. And, if you take it so that $100 are equal to $1, one new digital dollar, or one new SDR, then, the same kind of idiots who fall for the stupid propaganda on COVID and climate will also fall for the idea that we've fixed inflation by redenominating our currency. And so, we've gone from a world in which your lunch has gone, let's say, over the last 5 years, from $5 for the lunch to $20. Well, now it's down to $2. And so inflation has been fixed. It's not really $2. It's still 20 old dollars, but we've renamed it, and now it's 2 new dollars. And I think with that, we could continue to run, we can continue to see the model increase. So that's another 10x in the model, where if we just redenominate the model in the old dollar prices, we could continue to see it run for another few years or decades. What do you think?
Yeah, that is the great reset scenario, and I very much believe in that. And central banks are very open about it, right? They're not even keeping it a secret. They call it a new Bretton Woods moment, and are actively coordinating with that. You call it suspicious friendliness towards that goal. And and it would also solve the debt problem, right? The huge debt problem that especially the US, but also most European countries have. And that's a very interesting thing because, indeed, the global bond market is also about 100 trillion US dollars, just like the real estate market. Um, so if you could wipe out that debt by introducing a new currency, that would fix a lot of things for the US. However, the debt of one person is another one's asset. So, for example, all the pensions often are invested in most of the treasury bonds, and of course, a lot of U.S. treasury bonds are in the hands of Chinese and Japan as well. Um, so they will not like this plan very much, and they will oppose it or view it differently, or at least have a solution that doesn't hurt their assets. And I think that's one of the reasons why we see the Chinese buying uh, all commodity mines in Africa, all harbors in the Middle East and Europe. Uh, yeah, so acquire strategically important assets, with which they pay with dollars, to get rid of that dollars before they get useless. So or worthless, I should say. So yeah, I think that's a very, very likely scenario indeed, which will be good for Bitcoin unless they ban it, which could be the trigger for the next bear market, if you will, in 2023 or something. That they come up with this first digital currency and to altogether ban all the on ramps and off ramps for Bitcoin with that currency. So yeah, I see that as very likely, and yeah, and inevitable almost. And of course, the gold investors, they hope that that new currency, and that could be a digital a currency that will not be powered by proof of work like Bitcoin, and thus not be scarce. That new currency could be backed by gold. That's their hope. So in a way, I see, and I know a lot of gold investors, um, but I see gold as a call option that for that scenario, that new reserve currency that is gold backed again. In that case, gold would be revalued up overnight. But if that doesn't happen, the call option expires worthless. So it's a high stakes game, high risk game as well that the gold investors take, in my opinion.
Yeah, I mean, I think it's like backing, if they're going to pull something off like this and then to back it with gold, it kind of defeats the whole purpose. The purpose is to keep the fiat scam going. And if they go and back it with gold, then
Right.
they don't need to do that. They could just achieve the same result by individually going on a gold standard. It's meaningless to have an international central bank reserve currency to then go and back it with gold. Just have every central bank go on gold on its own. So I'm
Especially,
not so sure.
yeah, because that would stop the money printing, right? That would put a brake on how much money you could create, and that's of course not what they want. They want to create as much money as they want. So
Exactly, and
and it has to be done like that.
and it would also cause interest rates to rise
Right.
enormously.
Right. Right.
Yeah,
Yeah, I think
absolutely.
the other scenario is much more thinkable. That Bitcoin is starting to evolve an interest rate, right? With lending that's now going on, where you use Bitcoin as collateral, but also the futures market, where there's a large base or a premium between the future price of Bitcoin and the spot price of Bitcoin. And it doesn't extend that far in the future right now because there's only futures for 1 year ahead. But if that goes farther, like futures that are 2 years, 5 years, maybe 10 years long, then you'll have a real interest rate, a yield curve, like bonds have, and that must be a very frightening thing for traditional bankers and especially central bankers. If there is a commodity very scarce where they don't have any control over, that also develops a yield curve that's a competitor for the yield curves in treasuries. Wow, then yeah, that's the end game, I think.
Yeah, I think this is what we're seeing. I think we're just going to witness interest rates on Bitcoin continue to drop further and further until they drop below the interest rates of the central bankers. Well, I mean, central bankers are going negative, but we'll see.
Yeah,
I mean,
that
Bitcoin can go to zero. Bitcoin, I don't think, can go to negative interest rates, but I believe we will eventually get to negative to 0% interest rates on Bitcoin. That's one of my ideas.
yeah, I'm not sure. I'm not sure. That could be. It could be the lowest rate, and then you could lend or sorry, borrow money at the cheapest rate if you have bitcoins, which is perfect. Or it could stay high, and it could jump into that gap that's right now in the financial markets, that there is no yield. Everything is negative yielding or near 0%. So there is no yield. That's a big problem for banks, for pension funds, and there's a real demand, a real need for a yield curve that's not negative or zero, but um, that is reflective of the power of the economies in the world, and thus positive at 5 or more%. So that it could be that function as well.
Yeah,
It's very interesting.
it is. I mean, it's. I discussed this in the Fiat Standard as well as in the Principles of Economics book. I think historically interest rates have always been going down. Historically, as people save more, capital becomes more abundant, and then the price that you can charge for your lending declines. I think this process, if left to its own, free from the barbaric intervention of central banks and other criminal organizations, will lead inevitably to this interest rate declining to zero. And I think Bitcoin allows us a chance to have this. But it'll be interesting to see what happens with interest rates on the fiat markets. I think one scenario to look at is that everything becomes negative interest rate on the fiat markets, but then on the Bitcoin market you have zero interest rate, but you have number go up, you have appreciation, and so Bitcoin wins hands down because people would rather get appreciation on no interest than to get depreciation and negative interest.
Yeah, yeah, and I think there will be arbitrage as well between the fiat world and the Bitcoin world, as we are seeing right now. More and more not really institutions, but hedge funds and family offices and large investors are finding their way to the Bitcoin market because you can take the volatility and the huge returns that go with it, or reduce that volatility a little bit and make it comparable to stock investing or bond investing or gold investing, and have a higher return, or even do the cash and carry trade with Bitcoin and have a near zero risk return of 10, 20, 30%, which is unheard of in traditional markets. So
Yeah.
the arbitrage will be huge. I think that it's like a dam that holds the water, but more and more water is coming through, and at a certain point it breaks, and that's the arbitrage. That's a huge force in financial markets. And I hear big parties, not the traditional parties, but the flash trading companies, the hedge funds, there's so much money coming to the Bitcoin market. It's unbelievable, and they'll trade this thing until that arbitrage is basically gone. And right now it's right open. So they cannot believe what they see. The volatility in Bitcoin is an asset in itself, right? You can write call options covered and get that volatility premium, volatility harvested, first thing they call it, or the cash and carry trade is perfect. So for traditional investors, once their eyes are opened, they see arbitrage between fiat and Bitcoin everywhere, and also crypto, right? But there's a lot of risk in there. But it's like Valhalla for quant investors at the moment. It really is. Yeah.
Yes, I mean it's and it's a good thing. I mean, a lot of them are going to get burned, but these are the bridges we will need to cross and burn to
Yep.
leave the fiat world and get to Valhalla of hard money.
That's it. Yeah.
We need them to provide us with the fuel.
Oh, and they do, right? I hope they're not going to taper. They're gonna QE and print some more. That would be the
Yeah, good
perfect.
luck. Good luck expecting them to taper.
Exactly. They want to taper but cannot.
Although who knows? I mean, with inflation, it's difficult to predict how fiat world works. I'm glad that I no longer have to follow all of these things. But do you have any thoughts on the wider macro picture?
Well, um, I think Bitcoin is the biggest macro thing going on right now, but you have to have your eyes open, which is not the case in 99% of the institutional investors. So they see it as a small thing. But the other thing, of course, is interest rates, money printing, the QE. Um, that started with a banking crisis in 2008. But since COVID in March 2020, the printing has accelerated, and that is a huge force driving the market. It's driving interest rates to zero and below. It's driving the equity market because all that money has to go somewhere. Equity markets go up. It's driving the bond markets. Well, that's the interest rate markets, of course. But yeah, the bond buying by central banks and the money that is printed by the central banks goes to the governments first, and they can spend it on aid, help relief, COVID relief, helping companies that cannot do business any longer, like cruise lines and airlines and restaurants and all other business that they close for in the lockdowns and in the with this well and the whole choking up of the supply chain as we're seeing right now. I think that's one of the big topics and reasons for inflation as well. So there's the direct reason for inflation, that's the printing of money by central banks, but there's also the indirect reason that if you um yeah the, have all sorts of rules, COVID rules, and fire people for not being vaccinated, and so your labor force is thinned out in not only the hospitals but also harbors where they have to unload the ships. The whole supply chain, or the truckers that drive the cargo to the from the ships to the cargo houses. It, in the entire supply chain, we see shortages in labor now, and uh, it's getting worse and worse and worse because that logistic chain is so mathematically optimized. If the if there's even a little disturbance, it yeah it shuts down, or it falls apart. And now we have a big disturbance. Well, everything that followed COVID, the policies. So yeah, everything will get more expensive by the printing, but also by the choking up of the supply chain, and that will get worse and worse and worse. And that's a big macro economic thing. Inflation is certainly here to stay, uh, although central bankers are trying to dam it. Uh, and not allow it. I wonder how they're going to stop it, because they have to fix the supply chain, and they have to stop printing, which is something they cannot do. So they're probably going to blame something, or uh, come up with this climate thing. But they'll find some narrative. But oh boy,
Yeah, I
this
think
is
we can already see who's going to be blamed for all the inflation and the catastrophes. It's going to be A, the unvaccinated, B, the people who consume fossil fuels, because they're the ones who are causing the climate crisis that's causing all of this supply chain disruption,
yeah,
and also the vaccinated as well, the unvaccinated as well, because they're the ones who are getting fired and therefore leaving crucial jobs behind. And then, of course, I think Bitcoiners also, because they've dumped our strong and perfectly fine currency, and because they dumped it, they're
right,
causing inflation.
right. That's my fear as well. That Bitcoiners become will be mentioned in one line with climate deniers and COVID deniers, and because that's of course where you see a lot of wealth being made at the moment. The Bitcoiners are taking over the world, and that will be another interesting thing to watch. The game that the IMF is playing and the emerging markets. So what El Salvador did was very brave, very new, very well. It's a thing you can only do if you have a leader that has a lot of control over the country. Would be very difficult to do in a big democracy or a Western democracy that is very dependent on the central bank, the European or the U.S. central bank. But I guess more countries like El Salvador will follow. I heard some stories about Zimbabwe. I heard Brazil was looking at it. There's more. If that ball goes rolling, if more people follow, that could be a huge shift in macroeconomic play, where the IMF will certainly take action, and that could supply a new dynamic. But of course, those countries are now very small and not real players in the global economy. But yeah, it's very interesting. And then I think the big overarching geopolitical, maybe military thing is, of course, China-US. Always has been a thing, but it's with the South Sea troubles and now Tokyo, Hong Kong and Taiwan. Taiwan being the next maybe battlefield. You see the narratives changing. You see troop movements already. I think that could be a global geopolitical thing in the future. And then, of course, I guess the most important future event is the thing we don't see at the moment. Because if you asked me 3 years ago what would be the most important thing geopolitically and economically, I would not ever have guessed it would be the COVID crisis. So same for the next 3 years. Probably there will be some black swan event that we don't even know at the moment that will pop up and change the entire game as we know it.
Yeah, for sure. That's the thing. I mean, it's you don't know what kind of things are cooking under the surface, but we know which direction they go. So we would not have been able to think that a virus like COVID would have been the cause of this crisis. But the direction in which things went is also is kind of well known. It's going to lead to inflation, and it's going to lead to all of the increase in government totalitarianism. These things we can predict regardless of what the crisis is actually going to be. All right, we've got a bunch of questions waiting for you. Max, you want to go ahead?
Yeah, thank you, Saif. Thanks, PlanB, for sharing with us your knowledge and insight. First of all, I have to say I missed the first 15, 20 minutes or so. So maybe if I say something that is not appropriate, you can cut it out, whatever. So I have two questions. One is for PlanB and another one for both of you. PlanB, I saw you being interviewed on a YouTube channel talking about the stock-to-flow model, and you said that your prediction is that on average, during this cycle, the price will be around 100K. That's different from like peaking at 100K or staying within those bands. So this is something that relates to what both of you were discussing a few minutes ago with regards to the metrics to evaluate if the model has been broken or not. Saif was saying, well, if the price stays longer than however many days outside the dark blue area or the light blue area, then the model is invalidated. As far as I can see, this, the math of the model, not that I'm an expert in the math of the model by any means, but as far as I can see, that's a legitimate interpretation. So, but if it's true that the model predicts that on average, the price is going to be around 100K, then Safe. There is a scenario where Safe is saying, well, the model has not been broken. It's within the bands, but it never reached 100K. But according to PlanB, according to what he said on another place, that would mean the model is broken. So my first question is, what in the math of the model itself predicts this, that on average we're going to be around 100K?
Yeah, that's correct, right? It says on average it will be 100K in this 4-year period, and the chart with the confidence bands is, I think, very clear in that as well. So that means that we have to go. We have spent 1.5 years below 100K, so we will have to spend a considerable time above 100K to make that 100K average. And I think it's not inconsistent with that. The dark blue area should be populated with 67% of the bullets of the monthly closes in that halving period. So we're probably overshooting that dark blue area on the upside, spend some time there, going back, spending another time at the blue area above the 100K level, maybe shoot through that in the bear market a little. But in the end, yes, 100K average, or the model is invalidated, if you will. And also for the confidence bands, I think we should not spend, like Safe said, a lot of time, like 6 months or more, well, something like that, far above or far below the 2 standard deviation band, because that's also not compatible with the model. I hope that answers the question.
Yeah, but there is a hypothetical scenario where the price stays in the lower portion of the dark blue area, very close to the light blue, but still in the dark blue area, all of the time without ever reaching 100K. Yeah, if that happens, Safe is gonna say, well, the model is not broken. It's given that criteria. But when you say it has to be 100K on average, then you guys are making different predictions. I mean, one is going to say, well, the model is not broken. The other is going to say the model is broken, right? My question is, what in the math of the model says that, well, maybe this is too complex of a question, but the math of the model predicts this 100K on average, or is this a broader interpretation considering macro factors?
No, okay. I think I think I know what you mean. The model, of course, in the charts, right? In the charts, it's that black line in the chart with the blue bands, and it's the white line in my charts with the black background. So the model is purely the math. The function is that white line or that black line, and it's a fit. It's a linear regression line between the logarithmic of Stocktoflow ratio and the logarithmic of the price. And that regression line, the mathematical formula of that regression line, is fitted through the data. And that's why it is an average, at least for the past data, right, where the model is made. Mm-hmm. So it is by definition an average. And it should be also for the prediction for the future value, if you will, the future prices. It should be on that around that model line. Otherwise, the model is not valid, or should be refitted. But that would also be, of course, not the scenario I would like to see. But you could say we have to refit the model, but then of course the prediction will be off, right, lower than we're predicting right now. So no, the average value flows from the fact that it's a fitted model through historic data. It is by definition the average.
Okay, thank you. Another question, if you don't mind. When you came up with a model, printers around the world were already printing money like crazy.
Yep.
However, what we are seeing in 2020, 2021 is unprecedented. It's just ridiculous. And considering that the more money we have in the market, the more money is going to be directed to gold, silver, real estate, stocks, whatever, and Bitcoin. The most optimistic people could say, well, the model is going to be broken to the upside because it's way too much money coming. And so do you think this is this is a macro factor to be considered to expect more bullishness, or do you think everything is priced in regardless of how much money they're printing?
It's a great question. I get it a lot. So yeah, that could be one hypothesis, that it undervalues because the market, the printing has accelerated after COVID. But I could also say, well, we really need a lot of printing. We need it to go on, and the model expects that there is a lot more printing. Because I mean, the values that are predicted, 100,000, even $1 million Bitcoin, are outrageous as well. So it sort of implicitly takes that accelerated printing into account. That's another thing you could say. And a third thing you could say is, to eliminate the effect from money printing, I sometimes make this stock-to-flow to gold model. So I don't measure Bitcoin in dollars, but in gold. So, for example, right now, 1 Bitcoin is 37 ounces of gold, but it was below 1 ounce of gold. So you could make a exact same model, an exact same regression line, just measure Bitcoin in gold, and then the model it's still valid. It still is a 99 even percent R squared with a very nice fit, linear fit. And then you get rid of all the dollar and money printing effects because you measure Bitcoin in gold terms.
I just want to quickly acknowledge both Saif and PlanB. It's a privilege to have studied your material and listened to both of you. Thank you for everything that you guys do. My question is very simple, and I'm sure a lot of people are also wondering and thinking about this. Everything that PlanB says, and a couple of the other leaders in the space as well, like Willy Woo and some of the other people, they try to predict the nature of the price of Bitcoin, and obviously you guys are trading it. Whereas a lot of the other guys, for example, Michael Saylor, I think Pomp as well, they just have this strategy of just hodling throughout whatever. I have been hodling for about 6 months or so. So I'm fairly new into this, but I'm studying a lot. And I am actually tempted to trade versus hodl. And I do think I agree with Saif that we will have those massive bull markets and then those crashes. Can you talk a little bit about the strategy of hodling versus trying to time the market that is trading? And my question to Saif on this note is, what is your strategy, Saif?
No, I should say my interest in the model is, I'll let PlanB answer this because he has much more. My interest in the model is much more intellectual. I don't really trade, and I recommend people hodl, and I hodl. So it's not something that I trade on. I'm not a trader, and the fascination for me is in the fact that the model has done so well when I would expect that it wouldn't, and no model should do so well. In fact, I gave a course in Miami during the conference about this model and about what I think about it, and it got recorded, and I'm going to be uploading it to the website, so members of the website will be able to see my thoughts on this in more detail. PlanB, floor is yours.
Yeah, I recognize the need for trading or the lure of trading, but I would recommend against it. And in fact, I'm not trading myself. I'm more for the long run. And I guess hodling is the best way to go. Your risk and return estimation is. I mean, if you hodl for 4 years, you would never lose any money. So if you just sit and forget and look back at the money for 4 years, that will give you a very relaxed life and almost certainly a certain good result. But then again, I understand, especially if you expect some crashes, that you try to prevent those. And in fact, I would consider that something in between hodling and trading, because trading is a very short term thing, like daily trading or weekly trading or monthly trading. So I don't think that's a good idea, that short term trading. But if you just want to avoid the next crash, I think that would be a strategy that could be interesting. In fact, I am doing that myself too, and I did it also in 2017. So I think it's no secret that I bought Bitcoin in 2015 and 16, then sold half just after the all-time high in 2017, and bought it back in the beginning of 2019, just before I wrote or published the article. So I sort of prevented the dip in 2018 a little bit, and I want to do that again. But yeah, but that's, you have to know very certain. You have to be very certain and have a very strict strategy, because you will fall victim of your own fear and greed. And if you don't, you need a method. For me, I would need a mathematical model to guide me, because otherwise I would be ruined by my own greed and fear. So yeah, that's basically what I like to say. And then of course, I'm not a financial advisor. Neither is anybody on Twitter. It's everybody is talking their own book. So it's basically up to you, and it depends on how much money you have invested in Bitcoin. If you're prepared to lose it all, then by all means, go ahead and have some fun with trading. But if you put a lot of money in there, that's important for your life or your children's education or something, I would, yeah. It's very personal and very dependent on your own risk appetites with that money. And yeah, the one thing I can say is, don't ever do leverage, because that is certain death. But yeah.
Well, absolutely. That's a great answer. But I just wanted to clarify though, Plan B. What I meant was exactly what you did. So I'm not actually trading on a weekly or like a monthly basis, but when we see those high levels, fortunately in the next 4 to 6 months, when we see levels like 300,000, 400,000, 500,000, and then we're expecting a subsequent crash, should we be, hodling still, or should we be, closing our position there and accumulating some cash to buy in the future?
Yeah, that's a personal decision, I would say, right? Everybody has to make that decision themselves, and depending on their risk profile and how much money they invested. Because yeah, it's very difficult for me or anyone else on Twitter, for example, to advise on that. That having said, all my models are sort of tuned towards recognizing that moment, right? The standard deviation bands. If it's two standard deviations out, then I get worried, right? Then I know the top is near. When my on-chain models jump red and I see the FOMO transactions coming in, which are not there at the moment, but when I see that, I know, I have to be taking some money off the table. And so yeah, but everybody has to decide about how to do that, how to time that, and if you time that. And some people just say, well, Yeah, but the risk is also in the dollars, right? If the dollar becomes, if I sell everything, I don't have Bitcoin. I have dollars. That hyperinflation is eating my purchasing power away. So where should I put? I just keep it in Bitcoin, because one Bitcoin will stay one Bitcoin forever, and I don't mind the volatility. That's the hardcore line, the hardliners message.
Go ahead. Thanks, guys.
Yes.
Cheers. Stefano?
Yeah, thank you, Saif, and thank you, PlanB. So my question, Saif, is about something that you said a bit earlier about the fact that a central bank can issue a central bank digital currency, and then they can, over time, update its unit to make it to mask the rising inflation. So, for example, 10 units is now 1 unit, and therefore, nominally at least, the prices don't seem to be going up. But on the other hand, what truly matters is purchasing power, and people will be able to see that what they gain, what their income is, will not be able to keep up with the price of what they need to buy every week and every month. So why do you think that simply changing the unit can actually help to mask a rising inflation for a few years?
Well, I mean, obviously, it's not going to work on me, and I don't think it'll work on anybody here, or the majority of people we know. But if you've been following the world over the last couple of years, this is something that will work on the majority of people. And I think what will help make it work is when they restrict your choices on what you can spend your money on. So when you throw in the fact that you're not going to be driving, you're not going to need fuel because you're going to have a tiny little electric car that can only drive you 25 minutes away from your house before it runs out of battery, because people who drive cars with fuel are evil, people who are boiling oceans. Then, you take away the majority of energy consumption. If you are if you move from living in a large house, which requires you to drive and requires a lot of energy to warm, into living in a tiny little apartment in a big house, you're going to need a lot, in a big building, you're going to need a lot less fuel to keep your house warm. So I think the propaganda, this is a key point, I think, from the conclusion from the fiat standard, this is what they did in the 70s with both energy and food. And I think we're seeing something similar right now with the growing sound of hysteria around energy and food, that they're going to vilify the things that increase in price and convince you that the cheaper alternatives are better for you. And then that's just going to make your expenses go down. So, of course, meat is another big one. You won't be allowed to eat more than 20 grams of meat a day because, meat is for evil people. And so if most people can't afford meat, most people don't eat meat, and instead they eat bugs and soy because bugs and soy are better for the environment. That's a very significant chunk of everybody's paycheck. So redenominate the currency and feed people bugs and put them in tiny little pods and lock them up so that they don't leave the house, because that's the responsible thing to do, because otherwise you're helping spread diseases, because the only reason you exist is to spread diseases. So if we lock you up, we will make the world safe from criminals like you, and reduce the amount of energy that they need, reduce the amount of space that they consume. You've eliminated a significant chunk of people's consumption. So then you can see how inflation won't look so bad with the redenomination and with the reduction in consumption.
So basically what you're saying is that the rising inflation will be balanced by a deflation in the quality of life.
Yeah, declining the quality of life. It's kind of what happened in the 1970s. People's consumption of red meat declined, and people's consumption of cheaper forms of food have increased. So people substitute industrial waste for meat, and then inflation doesn't look so bad.
Okay, not very optimistic, but thank you.
Bitcoin users not affected, of course.
That's true. Thank you, Saif, and thank you, PlanB.
No problem. All right, who's Pleb? You want to go ahead?
Yeah, I got a question to PlanB. Thanks for the fascinating talk. And this is regarding the floor worst case scenario. Could you maybe talk about what numbers it predicts for the coming months? And I would be interested in if one can therefore predict or derive a prediction about the validity of the stock-to-flow versus the stock-to-flow cross-asset model, if there are any correlations whatsoever. Thank you.
So the November estimate is 98,000, and December is 135,000. And I didn't give any predictions after that because it's a very short-term thing. It's not like stock-to-flow ratio that I can expound that into in the future for a year or 2 years, even 10 years. So let's first see those two. And the reason that I can give those two, or actually the last three as well, so 5 months in advance, is because we are exactly at this lower floor at the moment. So I know we cannot go below it, or theoretically we can, but then the model, of course, is broken. But because we are at the bottom, I can extend it a little bit into the future. And as soon as we are going to start getting prices above the floor model, then I cannot extend it anymore. I know that sounds like a bit of a mystery, but I did, of course, not publish the model yet. So, but that's what it is, and it's completely different model than the stock-to-flow model, because it's not based on stock-to-flow ratio. It's based on technical analysis, that is price only input, and it's basically exploiting a mathematical error that most technical analysts do, because technical analysis was made for normal markets and not for Bitcoin exponentially growing markets with non-normal distributions. If it fails, it's too bad, but it doesn't say anything about the stock-to-flow.
Okay, but it's not like you could kind of foresee, okay, in January or February, the floor is going to be at like 300K, and therefore we're more likely on the track of the cross-asset model. That's not possible.
Okay, that's a third model, of course. So the stock-to-flow model, the data fits the stock-to-flow model best, right? If we look at the historical data of Bitcoin, like the charts we have spoken about, it fits the stock-to-flow model best. But the stock-to-flow X model also takes data into account in the fitting from gold and silver and real estate and diamonds. So in comparing those markets, and that's why it's called the cross-asset model, you get a different line that's slightly steeper, hence the higher price of 288,000 on average, right? So I think that's the fundamentally better model, because that compares store value alternatives for investors. But the fit with the pure Bitcoin data is better. So the way how I look at it, it's the stock-to-flow model is the base case model, and the stock-to-flow X model is the best case model. It's the fundamentally better model, and I think so they're not mutually exclusive as well. So we could go to 100,000 this year, say end of December, and then we could go further and further, right? We could rise further and maybe have a peak at let's say a top at 300, 400 somewhere 2022, and then and still keep averaging out at 288 later on. I don't dismiss that thought at all. So it will be very interesting to see now how high this bull market will go, the second leg, and where we will average out. And it can be anywhere between 100 and 288. That's how I see it.
All right, Bernardo.
Guys, thank you for the wonderful talk. I was writing the question down here. So basically my question to PlanB and you, Saif, is, do you see any other more profound consequences on the dystopian future where the on and off ramps of Bitcoin are banned everywhere? Or is it just going to be the short to mid-term price corrections in the bear market, but in the long term, we just say, and that's my viewpoint, but I think you might agree, just wanted to do, if the consequences are going to be something like the war on drugs that we have worldwide, where the consumption is not diminished at all, and you just make people who are Bitcoin dealers richer and richer, and everybody still uses it.
I mean, honestly, I don't know. I don't have a crystal ball, so I don't claim to be able to predict the future. All possibilities are open. I'd like to think that we won't see a war on Bitcoin similar to the war on drugs. I'd like to think that that horse has left the stable, in a sense that Bitcoin is already too mainstream. We already have people in Congress and in the Senate and in every branch of government who are into this stuff. It's not going to be easy to put the to put the genie back in the bottle and to try and persecute such a war. One thing that I think might happen, one angle of attack which I have not heard mentioned anywhere else, which I do mention in the fiat standard, and seems to me like a logical step. I think we'll get something similar, something where it will not be possible for you to get fiat credit if you are into Bitcoin. So if you hold Bitcoin, if you own any Bitcoin, and if you have any track record of being involved with Bitcoin, then you can't borrow from banks and you can't borrow on the capital markets. You can't issue bonds. I think this might be something that would happen, because I think if this doesn't happen, then we're going to get a lot more Michael Saylors, and we're going to get more speculative attacks on fiat currencies. And I think this is kind of a low-hanging fruit of some way to do it, where it's not entirely dystopian, it's not very difficult, it's not going to require something extremely elaborate to pull off. It's not going to require a lot of court orders and lawyers. It's the sort of thing that governments can pull off, with an executive order, with some kind of, extra legal procedure that is going to be difficult to challenge in court. I can see this happening because, as it stands, the speculative attack angle is very profitable, as we're seeing from somebody like Michael Saylor. You borrow dollars and you buy Bitcoin, and that causes Bitcoin to go up, and that causes the dollar to go down because you're creating more dollars. Borrowing dollars makes more dollar supply, and buying Bitcoin increases the demand for Bitcoin. So both these forces are tending to increase the exchange rate between the Bitcoin to dollar exchange rate. If more and more people begin to do it, I can see something happening where, the Federal Reserve just tells all of its banks, don't give any loans to anybody who owns Bitcoin. And I don't know how practical this is going to be in the long term. They want to lend. They need to lend in order for the system to work. They want to get GDP number to go up, so they like to lend. But it's not entirely infeasible for me that they could do something like this.
Okay, thanks. Just to follow up on that, and there's also a game theory element, right? There are nation states around the globe in which leaders are going to be benefiting from breaking that mandate and just adopting Bitcoin, like we have in El Salvador right now. But I don't know, if the concentration of power becomes more and more in the hands of the globalists, there's always going to be resistance. I don't know, in a sense, like Bolsonaro's and Putin's around the globe.
Yeah, I think so. Plan B, do you have thoughts on that?
No, not really. But I think it is very important that we have more countries like El Salvador that embrace it. And in fact, if we look at the US, how they embraced all the miners from China that were banned from China, and how they embrace derivative markets, future markets, option markets, and now ETFs, futures ETFs to start with. But we'll know on Monday if the spot ETF is allowed, and that trend is more like it's away from banning and more like adoption. So I'm quite optimistic, actually. Of course, they will know your customer it, and they will tax it, and etc. But they won't ban it. I don't think that's the way we'll go. And otherwise, we have to move to El Salvador.
Thank you.
Yeah, I mean, at least we'll all be together.
Yeah.
Which isn't going to be bad. There's beaches and Bitcoiners. And I'm sure we can arrange for the beef, so we don't need anything else.
I'll be there.
Excellent. All right. Well, this has been absolutely fascinating as always. Chatting with you, Plan B, is a lot of fun and pretty mind-blowing and pretty amazing to think about all the possibilities of what this is doing. Thank you so much for joining us, and I'm sure we'll be having you over again one other time to tell us more about why this model continues to refuse to break.
Absolutely. Thank you very much, Saifedean.
Cheers. Take care.
Cheers.